Good afternoon, or well, good whatever time of day it is that you're watching this. Welcome to another episode of the Everyday Trader. I'm Eric Hale. Before you go any further, like, subscribe, and comment down below. Helps us out. Appreciate all your support so far. Share this with your friends. Today, I'm joined by my friend and partner, Craig Jensen.
It is good to be here. And as long as you're bullish, it's good to be here. Markets are YOLO higher today, right?
YOLO, you only live once, as the kids say. For real, fam. Speaking like a Gen Xer.
For real, fam.
For
That
real,
is
FR, fam. Um,
that is
you,
crack.
when I went to get my haircut, I got a haircut yesterday. This is, old man haircut. I went to a new hairstylist and she was saying, she's like, well, how do you want me to cut? I'm like, I don't know, whatever you feel. She's like, well, the kids are, or she says, it seems like a lot of people today like the long in the, up on top and then the short on the sides, the fade. Unlike the broccoli head, which that's the Gen Z haircut. She says, I don't know, I had that for a couple. I didn't totally get there, but that's the direction I was heading. With a big floppy mop on top. Anyways, yeah, that didn't
I
happen.
have to
What's
say,
going on?
I have to say, my 18-year-old son has that exact haircut right now.
Yeah, I think it's she said they either call it the TikTok haircut or a fade, and she says we just call it a broccoli head. Then okay, broccoli head. No,
Well,
I am
the big news of the
solidly.
day. Yeah,
Was it
I was gonna say the big news of the day, what's going on in the market today.
not my haircut?
Not your haircut. Not my tomatoes that are growing in my driveway. Um, it's yeah, debt ceiling. We've got an agreement in place. It's now the House has passed it. They've sent it over to the Senate today for vote. The Senate, I actually was listening to Chuck Schumer just a little bit ago saying we cannot send this back to the House or it will fail. So they plan on passing it in the Senate, and it will pass the Senate as well. And then I'm sure we will no longer have a debt ceiling, and the markets like it today.
Yeah,
And
no debt ceiling. So we're just going to
yeah, no,
suspend the debt ceiling rather than raise it. Let's just get rid of it.
yep. So this is a little bit more interesting of a development in that in how they did it too. There's some of the tax increases that were promised by this administration have been put on the side. They're no longer on the table, at least until the next election, they're not. And so capital gains taxes are not going up, corporate tax rates are not going up. The tax on the wealthy, the highest tax bracket, those proposals for it to go from, I think, 33, where it's currently at, up to 39.6. That's not going up. And so all of those things very likely, obviously have a societal argument to them, but they're all, I believe, good things for the stock market. And so, yeah, the market is welcoming this and the fact that we're avoiding a shutdown. Now, hopefully, we're not speaking too soon and we don't still have some monkey thrown in or monkey wrench thrown in the gears. I don't think so. I think it's going to get passed and signed, and we'll go about now issuing a whole slew of short-term treasury bills to try to bring in cash to pay the debt. And likely what that's going to do is it's going to put some downward pressure on the dollar, and lower prices on the dollar means higher S&P, as well as just the fear that's been out there. I know, Eric, we've talked for about a month or so now, maybe even longer than that, about this uncertainty that's out there in the future, specifically in the VIX futures. I know you've got a chart that you wanted to talk about, so I'll let you talk about that a little bit. But I think that uncertainty is now gone, and the markets are welcoming that, and we're probably going to scream higher until the Fed stops us. Who knows when that's going to happen? But yeah, markets feel like they're going to break through this resistance level that's been holding them for a while.
Yeah, so big move up. The news, it's not a done deal yet. Like as you said, it still needs to get through the Senate, but based on Schumer and the fact that Biden supports it, I mean, there's Democrats have a slight lead in the Senate, but you only need a few of them to be on board. So Kevin McCarthy, this picture of Kevin, it looks like the best picture I've ever seen in him. This was a really big feather in his cap to be able to pull this together. And I'm surprised. I'm actually surprised that we were able to get it off. And it sounds like the Democrats really conceded quite a bit to the Republicans here. But nonetheless, whatever your opinion is, the deal's passed, and certainly the markets like it. We're seeing the markets go higher. We saw a move up yesterday, and certainly some strength today that I think is going to consider it continue. But what I wanted to share, where the real sort of evidence that this is something real is in the VIX future specifically. And we've been talking about this blue and the red line, which are the September and the December VIX. These are futures that are sort of prognosticating where the VIX is going to be in the future. And they've not looked right. We've been talking about this for a while. They've been significantly higher, indicating some sort of fear that's in the horizon. Now, the longer term VIX futures are always higher. They tend to be one slightly higher than the next, but they've been abnormally high. And as you can see here, we've had a pretty significant drop down just over the past 3 or 4 days. And this is all due to the fact that we're making progress on the debt ceiling. That's the reason why we're seeing this. Is the VIX that expires in June. So it's trades pretty close to the actual VIX itself. So we've seen the VIX come down to 15.82, but it's these VIX futures that have come down. We've seen VIX low before in the past, but the VIX futures not come down as much. And this has all been because we're not 100% sure. There's a number of things that factor into the VIX and the VIX futures. But I think the biggest impact, and we've been saying this for a while, is the debt ceiling. And I guess, there are adults in the room, whatever your opinion is on it, we've seemed to have made progress. And I think, as you said, this is a YOLO market, and the path of least resistance from here is up. So I don't see, there's other catalysts that are out there. And the interesting thing, you mentioned the Fed. Before we go on the Fed, did you have anything else to say about the VIX or the market?
No, I think this is not unexpected. I mean, this is good news. We don't want this debt ceiling crisis. It was a concern, particularly with the massive amounts of debt that we have. So we had to get this resolved. We've got it behind us. So the markets are welcoming it with open arms, and then we'll focus on macro later on. But for now, we got this big ugly monster out of the way of the debt ceiling. So the market's rallying in the short term. Could be a week, it could be a couple weeks. We could rally through the summer. We'll see. A lot of that will be, as you mentioned, I think next be determined by the Fed and what their next moves are in regards to interest rates. But that also seems to be, in the last couple of days, switching maybe a little more neutral versus hawkish. I don't know. What are your thoughts? I know there's been a couple of articles. There was an article yesterday in the Wall Street Journal by Nick Timros that I retweeted, where he insinuated that the Fed is kind of positioning itself for a pause, or instead of a continued rate increase.
Okay. There you skip. As a pause, is it a pivot? Is it yeah. I don't know. Phillips, this is Philip Jefferson. He looks like he's about to bust out a line from I don't know, Hamilton or something. He looks like
That's what I think. Yeah.
in that picture there. And my show is the screen's there, right?
Yep.
And okay, so speaking of that, if we jump over to the CME FedWatch tool, which does have its weakness, we are back solidly. I mean, we were at a 70% chance of a rate hike just a few days ago. And then we're back to a 73% chance or 77% chance of no change, because 500, 525 is where we're at. Listen, folks, tomorrow, this really doesn't mean anything until we get through tomorrow. Tomorrow is the big employment situation report. I mentioned this Brookings Institute conference last week, and one of the comments that stuck with me is that this inflation that we're seeing was not caused by wages, by strong labor market. But that's the reason why it's not going down. That's not what caused it, but that's what's keeping inflation from going down is the very strong labor market that we have. And we saw some, some numbers today that, unemployment is still strong. A continuing claims number is remarkably low. And then tomorrow, we get the jobs report, so we'll see where that comes out. And I think that's going to weigh heavy on where these probabilities lie. So I think right now the market is betting down, but my bet is that we're going to raise. But is it going to be a pause or a skip or a um, I mean, I think there's an argument to skip. The argument is that there's some lagging effect on Fed policy and maybe let the policy give it a chance to catch up. Um, if they are going to quote skip, I think the language will be very clear. But that's next week, right? When's the next Fed meeting?
Yeah,
It's
next week. Next week.
yeah, it's well, no, it's the 14th, so it's 2 weeks.
Oh, I thought it was the 7th for some reason.
No, yeah, that was May 7th, I think was the last one. Yeah, so it's the 14th is the next one. So we're going to have a CPI report. So don't take this to the bank. I mean, that's what we're seeing right now. I think strong labor market, sticky inflation, and it's going to be data dependent. So we'll see. But one thing that's certain is the market is happy. I think this 4,200 on the S&P 500, we're going to have a pretty significant close above it. And I think eventually 4,200 is going to turn around and be support.
Yep.
Bank of America and Morgan Stanley have both upgraded their forecasts, or Bank of America and Goldman Sachs have upgraded their forecast. JP Morgan and Morgan Stanley are still on the bearish side. They're sticking to their guns on the bearish thesis. Although I haven't read the latest in the past day or two to see where they are. But there's an interesting mix out there. My sentiment, though, is we're going to be bullish for the rest of the year. So I don't think we've seen the lows for the year. I think we're going to press higher. I think 4,300, 4,350 by the end of the year is realistic.
I read an interesting piece yesterday, and it was I don't remember the guy's name. It was Danielle DiMartino Booth retweeted him, and so I went down the rabbit hole that he had written, scrolling through her feed right now to see if I can find it. I won't take too much time to do it, but I'll summarize his thoughts, and I'm interested to hear your take on this, Eric. His thoughts were essentially that, if you take a step back, like really far back, pre-COVID, and you look at what caused this inflation, in his opinion, and of course you got to remember Danielle DiMartino Booth is not a fan of the Fed. She worked there for a long time. She feels the Fed has done a very poor job of managing the economy. But this statement, I actually agree with this somewhat. And his opinion is that as much as people want to point the finger at the Fed for this inflation problem that we have, it has nothing to do with the Fed. And that this inflation problem is 100% in fiscal policy.
Oh, yes.
And the fact that we printed $3 trillion, not the Fed printed, the federal government, Treasury, and put it into people's pockets directly, and then turned around and did things like TARP and the payroll protection plan, not TARP, the payroll protection plan. What's the other one? The employee retention credits, the ERC credits that the federal government has been taking their tax revenues and pumping it into the economy. And so in this guy's opinion, that's what's driven inflation. He still feels like there's $3 trillion of excess money in the system, and that he doesn't think the Fed can stop inflation even if they raise the Fed funds rate to 10.
Yeah.
That inflation is here, it is not going away, because it was Treasury, and until Treasury pulls it back out through either increased taxes or decreased spending, that's the only way we're going to get deflation to actually slow prices down. He said the Fed's pushing on a string with interest rates right now. And I thought, I kind of agree with that. I think if the Fed moved to 10, we may break a few things that could cause deflation. Who knows?
One could argue that we've not seen big changes in inflation. So, is the Fed having an impact? We're finally starting to see commodity prices coming back down. And some of the, it's a mix on the labor market. I saw that Zip Recruiters is laying off 20% of its workforce. That's kind of I don't know, there's some irony or something there. It's a recruiting company laying people off. Some maybe that's an indication that people aren't hiring. I don't know. We'll get a sense more for labor tomorrow. But there are other things that are out there that certainly could impact the market. One of the biggest ones we mentioned earlier, and then we took this away from our conference down in Florida, one of the rooftop discussion that we had after hours as the bar was being shut down and we were being kicked out. We were talking about this student loan thing, which is, I don't know if you caught that, right? That it's part of
Yeah.
the deal that we've agreed to, that's going through with this raising the ceiling, is that starting in August, anybody who's been on furlough, on holiday of having to pay their student loans are going to have to start to pay them back. And so your average family that's now going to come up with $500 a month that they were making before, but those gaps seem to get filled pretty quickly if you stop paying that, and to have to come back up to it. I think it's going to be a shock. That I sincerely believe that's what could push us into recession. But it's not going to really have full effect until the latter half of this year, and because it starts in August, and maybe September people are okay. November, December, people stop spending money on Christmas presents and traveling, and then we see it through the rest of the economy. So
Yeah.
I gotta get some more sense on how that plays out, but I think that's really a big risk that's out there.
Well, we shall see. We shall see. Interesting markets for sure. Before we finish up, I know you and I talked about dropping maybe some conversation about discussion about how to calculate return on a trade.
You want to talk about it? We can do that.
We can, or what, or do you want to do it on a separate recording? I'm okay you doing either one. Let's do it now. We're talking about it.
Yeah. So I had this conversation in their community with somebody about calculating returns, and how do you calculate returns? Pretty straightforward. A return on risk is looking at your return in dollars divided by the risk times 100%. So if you are making $25, risking 100, that's a 25% return on risk. It also makes sense to look at capital, return on capital. And you think of a trade like a collar trade. So in a collar trade, you have a long stock and a short call and a long put. And so you're buying the stock, so you've got a lot of capital in the trade, but your risk, the amount of money you can lose, is determined by the strike of the long put. The put limits the risk. But in terms of managing your portfolio, you really need to be looking at both calculations. One, because there's real capital. That capital's tied up that you're buying the stock, even though it's not at risk. It's a resource that you have. You think about resources you have at your disposal for managing your portfolio. Obviously, capital is one, risk is related. So these two are separate. Calculating a return on capital, I think, is an important number to look at. And also the way that the philosophy that we teach at Options Animal is for planning for your secondary exit. So often some people will do a trade that involves a short put, and the short puts secondary exit is what do you do if the short put ends up going in the money? Some people will buy the stock or let the stock get assigned to them. You don't really have the choice as to when that happens, but if a short put expires in the money, 99.9% of the time, maybe 99.999% of the time, it's happened to me where I haven't been assigned, where only once in 20 years of trading, but it's very likely that you're going to end up buying the stock. But that could be part of your plan. Some people do that, is they'll do short puts either alone or as part of another strategy, and they'll plan on acquiring the shares if the stock goes against them. So even though you haven't put the capital in the trade, you're setting the capital aside to buy. So if you're doing a calculation on maybe a bull put spread, you probably should be calculating the return on risk, but also the return on capital. In that case, the capital would be your secondary exit capital. And there's certain rules of thumb for metrics on what you should be making in order to make the investment decision make sense. Before I talk about annualized, any thoughts on your comments on either of the return on risk or capital or exit planning?
Only that it's the biggest mistake that investors make is that they don't understand, especially the risk side of things. They need you need to go through this exercise. It's not very hard, but the especially an early on investor, people get into the stock market and they think of it as the casino and gambling, and I want to get rich and I want to double my money because I had this neighbor that did it. But the better way to invest is to have a long-term, slow and steady approach that over time helps you attain the value of compound interest and compound returns on your capital. And to be able to do that, if you go through this exercise almost backwards, where you have this goal that you're shooting for of X number of dollars when I retire, or just maybe not even when I retire, I just want X number of dollars in my trading account. How do you accomplish that by your starting capital, and then what types of returns do you have to target to get that? Because too often people get greedy in the market and they go buy a call option on Netflix at exactly the right time, and the stock goes through the roof. Or Nvidia has been, maybe I should use that one as the more recent examples, a call option on Nvidia, and you make millions of dollars, and then you could do the same trade again and lose it all. There were some horror stories about that in 2021 and 2022. 2021 market went straight up. You had all these people making all this money. Market sold off in 2022, and they turned around and lost it all because they didn't understand return on risk and return on capital. So this is a really important part of, in my opinion, long-term success in investing.
But Greg is boring.
I know, super boring. Find
Well,
other things to entertain you.
yeah, that's the thing that you need to keep in mind too is when you're trading to to piggyback on some of Greg's comments is that you have no idea who else is trading out there, what their motives are. We saw a big spike when COVID happened, and we got a whole slew of new people who came in to trade in the markets, people who never invested in the markets, but they couldn't bet on sports anymore. So all of that gambling casino money came in. So you don't know if you're sitting next to somebody or listening to somebody who's doing this as a hobby or as a as entertainment or gambling. You have no ideas. I was interested back, I think I might have mentioned this. So I was listening to one of the spaces, Twitter spaces. Actually, I think it was the other one, Clubhouse, when Clubhouse first came out. And there were people on how to trade Tesla. And there's one guy in talking about his strategy that works for him, and he buys calls, and this other person was doing covered calls, and the two people were talking together about how their strategies work. And one guy was saying that he does 7 covered calls at a time. At the time, Tesla was trading for $700 a share, so that's like 1.4 million. That was Is that what that works out to? 100? No, it was a ton of money. Like, what is that? So it was
Yeah, that's 7 million.
yes, 1.4 million.
1.4 million.
Yeah, 1.4 million. So he's like, yeah, that's how big my portfolio is. And the other guy who was talking was spending $300 on short calls, not short calls. He was buying long calls that expired on Friday. And so here we have somebody who's got $1 million plus portfolio, and somebody who probably has a couple $1,000 on the same, talking to people and people listening. Anyways, perspective matters. You got to do some of these calculations. But one of the calculations that we advocate looking at is an annualized return on risk. And this is taking into account the duration of the trade. And the analogy that I use for people, just a quick sort of example is if I have two trades that require the same amount of capital, and I have one trade that makes 5% and one that makes 20%. So they both need the same amount of money. So which one do you want? One that makes 5 or one that makes 10? And the truth is you can't answer the question because you're missing a critical piece of the data. And the data, the question is, how long does it take me to make 5%, or how long does it take me to make 20%? And so let me fill in. So this example, this 5%, this hypothetical trade makes 5% in a month, and the 20% trade makes it in a year. Now, which trade is better? And the answer is the 5% in a month. If you make 5% in a month, now if you could make 5% every single month, not even considering the compound aspect, it's 60% annualized return. So on an annualized return, you got 60% versus 20%. 60% is far better, obviously, than 20%. Now, some people, when we use this calculation, they understand the idea of it being, assuming you're in that trade for 12 months, the logical response is to say, I'm not going to be in that trade or a trade like that for 12 months, which is fair. But a sort of a counter to that is that if instead of being in that trade continuously, what if you only did that trade 4 times a year? So if you did it 4 times a year, you're still making 20% annualized, but that means you're only in the trade for 1 month and you're out of the trade for 3 months. So you can select and still make on the same sort of return on an annualized basis, the same return. So you've got that, exposure factor that could be lower. um, Annualized return on looking at on for a long duration, though, does tend to come in for some of those longer duration trades that we talk about here, like for example a covered call. And we get a lot of our members here, the sort of crowd that we attract are people that are looking for these very conservative trades that generate income and allow you to control your risk. And a covered call is a very common trade for people to do and to continually roll the short calls. And it's realistic to assume that you're going to be in that style of trade for a year or maybe even longer. It's like owning a property and renting out the property. Why would you ever sell your property if you continue to make good money? And the question is, what's good money? And if you're not doing an annualized return on risk, if you're not keeping track of your cost basis and knowing how much you've collected in credits from selling calls and debits from buying puts and debits for adjusting the calls that you have to buy back for rolling them, you do not know whether you're making money or not. And I'll just pop up a spreadsheet just as an example. I didn't prepare this. This is something that I've actually do here. This is an example of a covered call. This was a little bit weird. The stock was trading at 837, and I sold a call that was actually in the money. So a strike that's lower than where the stock is trading, and bought a call that was out of the money. And this is an explosive covered call. The one thing people don't like about covered calls is what happens if the stock makes a huge move up. You only make so much profit. Well, having this extra long call allows me to make money if the stock does go up. So in this trade, this initial setup, my cost of the trade worked out to be 779.23, and the return would have been 577 in 7 days. That's a 0.7 return, but annualized return, and in this case, my capital and my risk are the same. So I've got annualized return on annualized capital here. It's a 38.6% annualized return, which is awesome. So what happened was a week later, the stock had moved up quite a bit. So I was able to sell that 890 call. Then the stock ended up turning around and well, it stayed high for a while, and I ended up rolling a covered call out. So I had a call that was in October on the 22nd. I rolled it to the 29th, same exact strike. And I did that for a 290 credit. Now look what that did in terms of my return. My return on risk went from a 2.7% return on risk, but my annualized return actually went down. Annualized return actually went down on the trade because I added 7 days to the trade. Now, 71.6% is an excellent annualized return. But the next adjustment that I did, I brought in almost the same amount of credit, not quite as much. Again, raising my annualized return, still again, lowering my annualized return. And finally, I ended up letting that short call get assigned. And the reason is the next adjustment I would have had to add on even more time and would have continued to lower my annualized return on risk again. Now, my goal is to try and get personally to get 20 to 30% annualized return on a collar trade on my capital. So on any sort of trade, I'm looking at this annualized return number, and a 53 annualized return is fantastic, making it a decent return. Now I free that capital up, and allows me to go do some other trade. So I'm a firm believer in closing trades, taking the money off the table, pay your commissions and fees, don't worry about it. But this annualized return, I think, is something that you should be incorporating into your trades. If you're not, you probably don't know whether you're making money or not. And I would encourage you to go back and look at the trades you've done and see, do the math. And I think you might be surprised to find out that some of you are actually making the situation worse, not better.
Yeah, I think that's a really important point. And, you brought up the idea of, instead of, and I'll just use a round number, 20% a year that you threw out there, annualized return. A lot of times people will look at it, 20% annualized return. That's easy math, right? It's, on a $10,000 investment, that means at the end of the year, I'm going to make, what is that? $2,000, right? Easy math. If you're targeting that in shorter blocks on trades that you don't have to be in it for an entire year, and still target that 20% annualized return, and then you're constantly reinvesting that capital and those profits you make, you actually can end up outperforming your just sticking in a trade for an entire year, just because of the reinvestment of profits as well. So that's another reason why I like to take profits on trades, and take my money off the table sooner, is exactly what you said. It frees up capital. And as long as you're using those same parameters to measure your annualized performance, uh, yeah, you'll find you're actually making more money over the year as well. So I think that's a excellent piece of an excellent nugget of information you just threw out there.
Right. I mean, so percentages, I've had people argue on these annualized returns because if you do some really short duration trade, and even if you make a small amount of money in a very short period of time, you can have annualized return numbers that are like 500% or 1,000% or more. And those are silly numbers. And so you need to keep the numbers in context. But I always say this, a friend of mine told me this, a colleague said this a while back in another situation, is you can't spend percentages. So you can only spend dollars. So percentages, you have to keep them in context. And this is just another metric, another tool to use to measure. And it does have its place and it does have its limitations. And certainly some people have criticized the fact that, hey, 1,000% is just ridiculous to talk about. And you're right. So you need to keep things in context, but it's a tool that I think that's helpful when you're looking bigger picture at your longer term goals. And if is this helping you get there? I find it very helpful for me. I also use the return on risk as a goal for closing my trades early. So we talk about having the most important thing is having an exit plan. When do you close your trade for a profit, or when do you adjust it? Knowing when you can close a trade early, if you've exceeded your target goals. If I'm supposed to be in a trade for a month and in a week I've made half of my profit, it's a no-brainer to close your trade early. And using that annualized return on risk that you're above some threshold, it makes sense to close the trade early. I just wanted to throw that out there. It's an interesting discussion that I had with some people in the community over the past week, and they said, that was helpful, that insight. So I wanted to share it with our friends and family here on YouTube land.
On the everyday trader, I'm shooting from the hip here, but I have an idea. Let's, at the end of every everyday trader, throw out a follow that someone that maybe you and I follow, or personally, or together, of suggestions for someone else to follow on Twitter. I just had an amazing picture come up, and I'm like, I wonder how many people follow that. You actually do. I may have gotten it because I follow it because you follow it. The Twitter handle is at World and Science. And that's actually the name of them too, World and Science. They have 2.4 million followers. A lot of people follow, just amazing pictures of the James Webb Space Telescope recently. So I'm going to throw that one out there, at World and Science. You have somebody you want to throw out, the people to follow on Twitter? Maybe something stock market related. I don't know.
No, I've been getting a lot of laughs out of this new AOC press.
AOC Press. Okay.
Yeah. So this is somebody who's it's a parody account posting. It's not AOC,
All right.
but it's pretty funny. She apparently has AOC upset. AOC has been posting, there's somebody impersonating my account. It's not me. So I don't know. I've been getting a lot of laughs out of that one. So probably, yeah, I don't know. It's not what you're looking for.
Hey, no, it doesn't have to be always related to the stock market. Mine isn't. Mine is mine is science. Yours is comedy. That's good.
Yeah, there we go.
Political parody.
Also, there's some other ones out there that I'll share, but I'll leave
Yeah.
that one. That one's been catching my eye here lately, and I've been laughing quite a bit. So yeah, I'll leave
Awesome.
it to you folks to decide if you want to follow it or not.
Well, it's good to talk to you, my friend. Let's do it again.
Yeah, awesome. We'll catch you later. Thanks.
Okay. See ya.
Yeah, bye.